So, there you are. You followed the plan, played it safe. Bought tech stocks because everyone said they were a sure thing. 6 months later, half your portfolio wiped out, and no one saw it coming. The truth is, even safe sectors can crush your savings. So today, I'll show you 3 sectors getting flooded with investor money. One might hold up, the other 2, total traps.
We're naming names and tapping expert insights. Fortunes could be made or lost. So stay with me. Sector number 1, technology. It's the poster child of every bull run. Artificial intelligence, microchips, automation. Every headline screams, "Buy now." Yet experts are sounding alarms. Some believe valuations are already stretched, and when expectations run this hot, even great companies can collapse under the pressure. Jason Zweig of the Wall Street Journal recently said, "When everyone agrees something is a sure thing, it usually isn't." Too much hype, not enough breathing room. That's the risk in tech. The second sector, consumer discretionary. This sector includes retail, travel, luxury goods, entertainment, and automakers. It thrives when people feel rich and spend like it. But debt is up, borrowing costs are climbing, and some economists think a pullback in consumer spending is already underway. Harvard's Ken Rogoff warned recently that consumer behavior is more fragile than it looks. This sector depends on sentiment, and sentiment can turn fast. If a sector looks too good to fail, why are the smartest investors quietly walking away? Let me tell you exactly why. If AI hype fizzles or the market corrects, this sector could take a serious hit. Retail investors could be the first to get burned, and you could be next. The third sector to watch is infrastructure. Roads, bridges, energy grids, ports, all the boring stuff nobody talks about until it breaks. But smart money is already moving in. BlackRock, Vanguard, and State Street have all increased their exposure to infrastructure funds in the last 12 months. BlackRock CEO Larry Fink called it a golden age for infrastructure, driven by global demand and real assets. Vanguard described it as a long-term defensive play with inflation protection. The infrastructure sector isn't flashy, but it's built on government funding, cash flow, and long-term necessity. That's what long-game investors look for when everything else is noise. This sector could be a barnstormer, some say. So, 3 sectors, and uncertain future outcomes. Where does that leave you? If a sector's too complex, too new, or feels like it's only going up because everyone says it will, pause. Step back. Weigh the risk that everyone else is wrong, which they just might be. If a sector feels too perfect, too obvious, or too hyped, ask yourself what happens if it all goes south. Can you handle that? If so, go slow. If you want in, use price averaging. Stay alert. That's how pros stay in the game while others get wiped out. We're not telling you where to invest. We're showing you how to think before you pull the trigger. And remember, things can change fast. That's just one more reason to question everything, even the experts. If this opened your eyes, don't miss what's coming next. How to invest without a stockbroker, and whether it's a smart move or a trap. Hit like and subscribe for smarter, safer ways to build wealth. One sharp decision at a time.